Hello, I'm Chris Hughes, the Chief Editor of Abu Dhabi Finance Week, and thank you for joining us all here today at Asset Abu Dhabi. We're about to meet Stephen Schwarzman, the Chairman and CEO of Blackstone, a global investment powerhouse with over $1 trillion of assets. A legend of both Wall Street and all of world finance, he is one of the wealthiest people on earth. He's a trusted advisor to some of the most senior leaders of both business and government worldwide. He's a notable philanthropist, and he's the author of a fabulous book called What It Takes. Steve is recognized as one of the most savvy, intelligent investors in modern history, having leveraged data, intuition, powerful macro forces to ride multiple market waves with precision, skill, and persistence. To unpack today's question, what endures when markets shift? Let's meet the man, the myth, the legend, Mr. Stephen Schwarzman.
What are the three most important changes in the global economy today? And what does that mean for investors?
Well, the three biggest changes in the world is that, first of all, the U.S. is going to be on an interest rate lowering cycle. And that has a variety of impacts economically. It's a support for equities in particular. In terms of the second biggest impact is the AI revolution. And this is hard to overestimate. If you're living in the United States the way I do, it's permeating almost every part of economic activity already. Just starting. Massive capital expenditures, massive demands on the electricity grid. We're going to have to theoretically double the size of our electricity grid to deal with this.
That's a big thing.
It's a huge thing. Yeah. And to create electricity, you have to have a lot of other things happen in society. So that's a second trend. Sort of a third trend is sort of the difficulty that Europe is having in this time of enormous innovation. And the attitude of, sort of let's regulate it if it's moving. It's discouraging for certain types of new businesses, economic growth. And I think there's going to have to be some modification of that. I think the Europeans are sensitive that that's gone too far. So it's going to be interesting to see how Europe adapts to the need for change.
Yeah, I think investors are watching that one carefully, particularly the one in Europe. There's a new regulatory agency every day, it seems, over there. But if we move on to the next question, you have been investing for a long time. You've seen, right from decades ago, cycle after cycle. What have you learned from investing through the cycles?
Well, I guess one of them is that trees actually that do not grow to the sky. And people get so self-confident and overconfident, sort of developed stage of a bull market of economic activity, that they make plans that retrospectively you say to yourself, what were they thinking? So that's one of the things. Secondly, investors don't really want to make money. They want to have psychological comfort. So they don't buy at the bottom, as a rule. They get scared at the bottom.
Yeah, kind of scary.
And they like to just see something going up. And the more it goes up, the more confidence they have.
Yes.
So you can't convince anybody to do IPOs at bottoms of markets, where if they bought those securities, they'd make a fortune.
Yeah.
They just wait till markets are really, really hot, and they think that anything they buy will go up. and you can sell enormous amounts of securities that are actually pretty unattractive. And that results in bad outcomes.
Yes.
On the other hand, what all of these indicators do is they tell you where you are in the cycle. One lesson I've learned is when things get bad, you don't buy. You wait till they get worse. Because what happens when things are collapsing, you can buy something that you think will be successful, say you'll make a 20% return. In fact, that's true. But what happens is it usually keeps getting worse. And then you become underwater with losses on the things you bought. And you keep hoping things will get better, but of course they continue to get worse. I've learned you can't pick bottoms. But what you can do is observe when they actually start going up. Don't try and be a genius. Wait till they start going up. You could miss the first 10% from a market move, no problem. Then you load the boat and you will make an enormous amount of money. So there are these simple lessons that I've seen over the years. Most people violate them. I've been around so long, I don't violate them anymore.
Well, you call them simple lessons, but I'm sure people would respectfully disagree with you. It's taken a long career to learn what seems simple to you, which may not seem, obvious to other people. But at the beginning of the interview, you talked about trends. You talked about, AI. You talked about, the events in Europe. I want to ask you, popular perception or opinion that's very prevalent in today's market that you would disagree with, that you would challenge, and why?
One example of that is a current concern over private credit and how risky it is. And there were several bankruptcies that were popularized in October before this conference. And they were blamed on private credit. In fact, all three deals were due diligence by banks, underwritten by banks, and syndicated by banks. And private credit was sort of not in the room. For some reason, people are concerned about private credit simply because they don't understand it. There are different types of private credit on loans, private loans to companies. We have an opportunity to do a lot of due diligence. And when we buy that loan, we don't syndicate it to anyone. And so it's cheaper to the borrower. They don't have to pay syndication costs. And they also know what their cost of money is, whereas banks have some flex in terms of how they can price it. And we are financed not by depositors who can take money out and you have to sell the assets, but we tend to match fund the maturity. And whereas banks are leveraged at least 10 to 1, private credit is maybe 0.4 of leverage, so 1.4 times instead of 10. So the matching of maturities is more conservative than bank loans. And the leverage is much, much less than bank loans. And so private credit is actually much more conservative for the system. And that's something that for some reason, media has gotten wrong. And so that's one of the biggest sort of scratch your head moments of what are they thinking?
Well, that's why we're here, to try and change the narrative around these things. Blackstone, an icon of Wall Street, we all know the name. We have a huge amount of respect for the company. Huge in alternatives. How are Blackstone adapting, staying ahead in that space?
Well, we started nowhere, as you mentioned.
Yes.
We had $400,000 of capital. We never put any more in.
Really?
And our market cap at the top of this cycle was around $250 billion. So one might say that was a good run. It didn't come instantaneously. We're 40 years old now. We're having our 40th anniversary. So you asked the question of how do we stay ahead? Well, we're always running hard. And the way you stay ahead in our type of business is you have to see market trends before other people do. And then you design new products for customers that are going to be terrific. I call that first part, it's pattern recognition. We're very fortunate in that we set the firm up to have enormous amount of feeds. I wasn't the smartest person in school, but if you gave me a lot of facts, I can figure out what they meant. So we constructed Blackstone in a way to help me figure out where the world was going without reading other people's economics reports and just listening to them. So I love raw information. They now call it data. I got a fancy name for it, just information. And we now have 250 companies that we own, way more, including minority interests. We have 13,000 pieces of real estate. We're the biggest commercial real estate owner in the world. We're the largest private equity firm in the world. We're the largest direct extender of credit for third parties in the private area. And this complex is really very powerful in terms of generating data. And the way we mine it is every Monday, myself and our senior people at the firm meet with every one of our business lines, and we listen to what's going on. We have new deals that we approve or not, which is sort of like a master class, for our younger people, because we had everyone in every group attend either in person or virtually. And one of the benefits of that is we all can see things that haven't been publicly reported to the rest of the world. And we do it globally so that we learn what's going on in almost every country. We can see changes that are happening before other people. We're not smarter. We just have a system that allows us to see that. And when we find something that's at variance that we think is going to take the world in a different direction, or the market in a different direction, we design a new product to take advantage. And with the older products, we change the asset allocation to make sure we always do well. So that is the core, along with fantastic people. You can't be good in finance with people who are 8s, 7s, 6s, 5s, so forth. You need 10s and 9s.
Yeah.
And when you have people with that talent and a will to win, so which means do the right thing, not win at any cost, but understanding that there's an opportunity, and how do you get that? And believe in meritocracy and excellence in everything we do. And we try and be the best in the world at whatever we were attempting to do. So if that's your culture, and that's your information flow, and that's your human resource talent, I expect we'll continue to be doing really well in the future.
What would you say? Not a bad run.
Not a bad run so far. But that's behind us. All that matters is where we're going
Yes.
and how we get there.
And the future's bright. Steve Schwartzman, it's been a pleasure. Welcome to Abu Dhabi Finance Week, and thank you for joining us.
Thank you.